Good afternoon, everyone. I'll be speaking about select options strategies in the Indian derivatives market. This is Sanjay from Ramaya Institute of Management. Today's agenda is very interesting. We'll go through and revise some basic options knowledge so we understand some of the contents better. There is an interesting story behind this, and that's before this webinar, we did send out a small survey to all the respondents who have registered for this webinar, and 60% of them said that they also have basic knowledge in options, which is a prerequisite here, and that's the reason why I'm going to review some of the basic options knowledge. Interestingly, we are in times of highly volatile Indian market, and we will go through some select strategies, particularly bullish in the Indian market. We'll take some examples and go through some scenarios for a better understanding as to how to make best of this current volatile market. What should a investor, short-term investor or trader do in this market? And of course, we'll follow up with questions and answers. This is the most important slide. And that's, please do your own due diligence before you make any investment decision. There's an important disclaimer, right? There is a risk of loss in investing or trading in securities, particularly futures and options, which you should be aware of making any investing and trading decision. This can also lead to possible loss of principal. There are no promises, guarantees, or warranties suggesting that any trading, investing based on strategies, based on any other information or tool in this webinar will result in profit or will not result in a loss. Ramaya Institute of Management and I make no representation regarding suitability of a particular investment or investment strategy. You are responsible for all the investment decisions you make, including understanding the risks involved. And this webinar is purely for educational purposes only. Having said that, time for India to rejoice. Why? Because the Indian derivatives market, the National Stock Exchange of India, has become the largest exchange in the whole world by trading volumes. Till now, it was the US-based Chicago Mercantile Exchange Group, the world's largest derivatives marketplace as per the FIA data show. So what has happened is last year, the National Stock Exchange notched up about 6 billion contracts traded volume in 2019, which is up from 58%. When I say derivatives, it includes options and futures and possibly some forwards, but we have surpassed the CME group globally, based in Chicago, to become the world's largest exchange, right? So that's what 6 billion vis-a-vis 4.83 billion. So time for Indian derivatives market and all the participants to rejoice. This makes it a very pertinent discussion because we are discussing the options and derivatives today. But the point is that there is still a lot of scope here. For example, our stock market valuation is currently at 2.2 trillion based on the current data, last year's data, in comparison with USA's 35.5 trillion US dollars. So there is still a lot of immense scope of growth, but definitely time for us to rejoice. NSE, the National Stock Exchange in India, is the largest exchange by trading volumes. So coming back to the review of options terminology, and option, as you know, is a derivative. Derivative by definition is something which is derived from the basic underlying. We are saying there are types of option, call and put, and this is just a revision, as I said. So people who know this, please bear with me. A call is an option to buy, and a put is an option to sell, right? And therefore, we are talking about the right. When you talk about a call, an option to buy, you're talking about the right. I don't have any obligation per se to buy or sell an underlying instrument, which is obviously the stock, right? So when I buy an option, it can be a call or a put. I have the right, but not the obligation to buy, right? Or sell, which means at a certain point in time, when the expiry date comes, I may buy or I may not buy, right? So that's left entirely up to me. And the same thing that when you buy an option, we are talking about buying an option, you are not obligated to buy or sell the underlying instrument. I simply have the right to buy it at the fixed strike price at expiry. And that's what I'm, in order to further clarify, I'm saying State Bank of India, the underlying stock, 2 days back, I believe on Friday, it was quoted at 189.25 rupees. The call option was quoted at 10.65 for the 190 strike price. The marketable lot for SBIN is 3,000 shares. So this is per call option price. So if I buy the call option, I typically need to invest 10.65 rupees multiplied by 30,000, which is 31,950. By a predetermined date, which is June 15th for this month. It is the last Thursday of every month, so July 30th of next month. But basically what I'm trying to say is I just need to invest per call option only 10.65 rupees. And what's my risk here? My risk here is only 10 rupees 65 paise, right? So it is only the price what I paid for it. Whatever happens to State Bank of India stock, by the way, come back to the disclaimer, I am not recommending this stock, or I am not recommending this stock. I'm stock agnostic, but I'm saying that I still have the right to buy SBIN at 190, the strike price, right? Now let us see the advantages of options vis-a-vis. Had I invested in SBIN and stocks for 3,000 shares, I would have invested 189.25 into 3,000. That comes to a whopping 5.68 lakh rupees, right? So I would have invested 5.68 lakhs, whereas if I buy an option, which is a derivative call option, I just need to invest 31 or 32,000 approximately, right? So that's the leverage which options give, right? You can control the market. You have a view. Suppose you have a positive view. You are having a positive view, not at investment of 5.68 lakhs, but you are controlling the market view, your own view, by investing only 32,000 rupees. And your risk is what? Your risk is only the amount that you have invested per call option, and that's only 10.65 rupees per piece, or 3,000, because that is the marketable lot. Each and every company stock comes with a marketable lot. In SBIN case, it is 3,000. It varies from stock to stock. For example, in Hindustan Unilever, which I am also taking as a case example here, it is 300. So the marketable lot varies from stock to stock. Now let's talk about, when does option become an obligation? When does it impose an obligation? Then that happens during the selling time. So if I sell an option, it could be a call or a put, it obliges you to buy. So if I have sold puts, because I took the example of call there, buying the call, let me take the example of sold puts in this scenario. If I sell puts of a particular stock, I am obliged to deliver that stock if at expiry the put option expires at the price at which the market ends, right? Let us take this in form of an example because so that we can have some clarifications. And this actually definition also gives a lot of opportunities for the options investor. There is something called a cash secured put strategy. When you say put strategy, which means in this particular strategy, option strategy, I am selling a put of a stock. And it is cash secured, which means I have already allocated a certain amount of investment for this particular stock, for selling this particular puts. And that's the reason why I'm calling it a cash secured put strategy. What is this strategy? To give you the context, as a proper investor or as a sensible short-term or long-term trader, I would like to have a portfolio of blue chip companies, for example. Let's say, for example, Hindustan Unilever. Again, I'm not advocating the buying of Hindustan Lever, but generally saying as a part of my long-term portfolio, I would like to have a portfolio where I have blue chip stocks. Why blue chip stocks? Because of the COVID situation, the market has crashed 30 to 40%. I have a lot of blue chips available at throwaway prices, at least 30 to 40% down from what it is before. And as an investor, I have done my analysis. What I've done is I've seen at the 2019 prices of Hindustan Lever, I'm just taking one approach, and I've found that the minimum price, the 52-week, which is the yearly low and high for Hindustan Unilever, was 2,600, and the minimum price has been 1,800, which means I'm absolutely fine to buy. I've done some fundamental analysis. I'm very sure Hindustan Unilever is a great buy despite it having a high P ratio in the consumer products market. I am saying that consumer products is an expense which you can't avoid that, and therefore my reading is that consumers are going to buy consumer products despite whatever happens, despite them having tight purse strings. So I am saying that I'm okay with buying Hindustan Lever at 1,900, and which in case the market is good, because it will go anywhere. My view is long term, in a year it should go up to 2,600. And I possibly, my thinking is that last year it did go to 2,600. The minimum was 1,800, 1,900, and the max was 2,600. So it was about a 30 to 40% jump. So what I can do here with the cash secured put strategy, anyway, I have already set aside some money for Hindustan Lever for investment, but I'm very stubborn that I need to buy it at 1,900. So here's where the cash secured put strategy comes into the play. What I can do is I can sell Hindustan Lever 1,900 put and assume that the market rate is 50, right? Then every month after month, I can sell that market lot of Hindustan Lever is for futures and options is 300. What I can do is I can sell one lot or two lot, depends on your capacity, every month. So one lot would fetch 1,500 to get a monthly return in this case, right? And when do I get this return? At, let's say I sold the put of 25th June, which is the monthly expiry. If the price of Hindustan Lever, if it doesn't touch 1,900 or below, I have pocketed that 1,500 rupees, right? And there are many companies. I mean, you can pick up any blue chip companies, and there I'm sure you can get a much better rate than what you get at Hindustan Lever. This is just one of the current price examples which I took. When the market goes down, the price of the put option obviously increases. So what I'm really doing is I have already cash secured the put. I have already put 6 lakhs aside for long-term investment in case Hindustan Unilever expires at 1900 and below at the monthly expiry date, right? So what I've done, in case, what is the worst case scenario? The worst case scenario is that Hindustan Unilever will expire at 1900 or below at the monthly expiry. In this case, selling, I have sold the put and therefore it imposes the obligation. And what does this oblige? It obliges me to take delivery of Hindustan Lever at 1900. And which means that I have the right to take delivery of Hindustan Lever at 1900. And how much money do I spend? 6 lakhs. Not exactly 6 lakhs, right? It is 6 lakhs less the premium because I already got 1500. It could be more also. So my net price of Hindustan Lever, which earlier anyway I had plans to buy at 1900, I'm getting it cheaper, right? So this anyway was a part of my long-term investment plans, plus I get the put premium. So this is one of the examples of how do you leverage the definition. Now I'm trying to leverage the definition of the obligation which is imposed on me as selling a put. I'm taking the delivery of Hindustan Lever, right? And so this is the risk management strategy which I have for long term. I can, what are the positives? If the stock goes up about 1900, it's currently around, I think yesterday I saw it was 2100 odd, but it moves in the range of 1800 to 2600 in the last 3 months. But I mean, whatever it happens, it obliges me to take the delivery, but I get a monthly income. If it is above 1900, I don't really care because I'm getting my regular income. So this is one of the way where you can have a cash secured put strategy. If the market goes up, you win. If the market goes down, yes, you have to take the delivery, but it's a part of your long-term investment plan, right? So as a long-term portfolio investor, you will always, when you start to build a portfolio or when you start to take advantage of this strategy, given the fact it's a good time to take because the markets are down, you can buy blue chip stocks or even the first grade stocks at cheaper rates, and cash secured put is a good strategy. This is the example, a screenshot of the National Stock Exchange, where you have calls and puts prices. This you may want to look at it. This website, obviously you are aware of it, naseindia.com. Having spoken about calls and puts, we also said we'll just do a quick review of the option Greeks, which actually point you out to the sensitivity of the option. Just to revise, the first Greek that we are aware of is known as delta, and delta measures the sensitivity of an option price to the change in the underlying asset price, or it could also be the speed. It is the first derivative. And typically when you buy options, you have positive delta. And the reason is because the underlying stock will go towards the call option value, and therefore your position will become more valuable as stock price rises. And that's the reason why we are saying that a positive delta, which means that the position will become more valuable. Gamma obviously is the rate of change of delta. The other important Greek, apart from delta, gamma is definitely important, but it's more important on the expiry days of option trading. But theta measures the sensitivity of option price relative to time left to expiration. So if June 25th is my expiry date, and when I buy options, the time decay will hurt this long position, because after 15th, after mid of the month, the time decay will hurt the option. And as you all know, an option is a summation of, many of the books will tell you, summation of the intrinsic value and the time value, and time decay will keep on lessening as time goes by. Typically in a month, when in a case of monthly expiry, it has been observed that from 15th onwards, or sometimes earlier also, there is a decay which sets in from 15th to 30th of month. The time decay is accelerated, and therefore the options tend to lose value. It could be call as well as put value. But for the option, people who sell options, which means suppose I sell an option at 1,000 rupees and my view is bearish. I say that this will become 200 over a period of time, and I'll sell at 1,000 and buy at 200. This time decay is actually beneficial, because when I sell at 1,000, I want to buy it at a cheaper rate. And after 15th, when the time accelerates, as time goes by and the intrinsic value does not increase, time decay actually aids the option seller. So that's very interesting to note. So you can definitely consider the fact that you can use option. Theta is always beneficial to option sellers, and that's the reason why that's beneficial more to option sellers than option buyers. And now we'll discuss the strategies for bullish view, one of the important points of our agenda, which means here I am having a positive view on the stock. Let's say again, go back to the State Bank of India example, and I have a bullish view on State Bank of India trading. I think on Friday this closed at 189.25 rupees, and my view is possibly that it could go up by 10% or more, but that's was my personal view today, and possibly yours could be 15, anything. But the point is, what can I do? What are the options, alternatives that are available? I bought, let's say my call option for strike price 190 is available for 10.65. Now, as a bullish strategy, I have a couple of alternatives before me. The first is known as a long call strategy, which means I just buy a call for 10.65 for the strike price 190, and my investment here is 10.65 multiplied by 3,000. I think we took the example when we spoke about buying a call. I've just kept the same figures for better understanding. And my investment is 32,000 approximately. So what are the advantages of the long call strategy? My view is bullish, and let's say the stock price rises. What are the benefits? The benefits are that the reward is unlimited. Right? So if it goes to 200, 250, there is no limit. There is my gain limit is unlimited. If it goes to, God forbid, I'm sure it doesn't happen because it indicates high volatility. It goes to 200, 250, the difference, because at expiry you get out at 250. So, but you bought it at strike price 190. So your gain will be 250 minus 190 into 3,000. Amazing return, right? But what are the risks? The risk is that the entire call premium paid is the risk. And why is that risk? Because what if the market doesn't go as per my expectations? I'll make a profit if the stock goes above. When will I start making profit? I'll start making profit at my break-even point. And let's focus on this a little bit. My break-even point is 265. Why is it not 190? Because I also paid for my premium, right? So I need to recover that premium in order to make some profit from this point. That's my base price. So 190.1065 is 200.65. So wherever the stock SBI goes up above this level, I will start making profit. And that's my advantage of this strategy. The reward is unlimited. There is no limit because whatever maximum price the stock reaches at expiry, that's my profit. Come to the disadvantages again. Let's take it in details. The risk is the call premium paid. And why is it the call premium paid? Because if the market goes down, I'm losing the premium partly or fully based on the price momentum of decline. Imagine I paid 10 rupees 65 paise, 31,000 rupees, 32,000. And if the market is not bullish, what will happen? If the market expires at 190, what will happen? I lose the entire premium, plus I lose the entire premium because I pay 10.65. So that's the disadvantage. How can you alleviate it? Which means, suppose the market doesn't go as per my bullish view and the market starts dropping. Possibly I can square off my position and save some premium. That could be one option, but I don't know whether at that time I'll be on the monitor. I'm a full-time trader, part-time trader, but whatever it is, we must be aware of the risk. And the risk is that the entire call premium paid can just evaporate in a matter of time. But so that's one long call strategy where we spoke about the benefits and the disadvantages. Another interesting call strategy is known as a bullish strategy, which is known as the bull call spread strategy. And this strategy has been also been very popular during events like elections, though there are many strategies to tackle that based on volatility, which is the unpredictability of the market. But this strategy also has been used to manage various events where you say that after an event, the outlook of the market would be positive. So here what we do is we have a combination, and that's a spread. And that's where the definition of a spread, the step one is to buy a lower strike call. And in this case, my SBI is running at 189.95 and I'm buying a call of 190 rupees. But what do? Is I sell the same number of higher strike calls, which means I sell 195 or 200 with the same expiration date. That's known as the bull call spread strategy. And let's look at what it actually means. So the bull call spread strategy is what we are discussing about, and let's break it down into details. I have my underlying stock at 189.25. And the step one was to buy a lower strike call, which I bought at 190. Why is 190? 190 is lower than 200. That's the reason why I call it as a lower strike call. So I have a bullish view, and I'm assuming that I have a view that SBIN will go by maybe 10% or more. And I buy, let's say at 190, I pay 10.65 per call. Again, the same example, my investment is 10.65 into 3,000. Why is it 3,000? Because that's the marketable lot. If you buy Hindustan Liver, it's 300. If it's something else, it could be Apollo Hospitals, for example. If you buy, the marketable lot is 500. Here it is 3,000. So I invest 31,950, and the step two is sell 200 strike calls at 695. But what happens when I sell the call? When I sell the call, I receive money, and I receive the price. Now, all these prices I've taken on the Friday's closing price, and so these are realistic figures. So I receive 20,000, or let's say 850, 21,000 approximately by this strategy. So what have I done? I have bought 190 calls and I have sold 200 calls. And if this market at the expiry date expires at 200 or more, what really happens? Compared to long call, my risk is limited, but my reward is also limited. I will not get as much as what I got. Possibly I'll get a reward of about 200%. The reward would be because I bought the call at 190 at 10.65 rupees, and the market closes at 200 rupees. So which means that I have, I have at the same rate, I could buy my call at 200 and sell in the market. So the difference is 200 minus 190 into minus 10.65 into 3000. So the maximum reward is limited. It's not unlimited as per the long call strategy. But what are the advantages? The advantages are that what's my maximum risk? My risk is 31,000 minus 11,100. That's only 20. So I have reduced my risk. Instead of 32,000 now, my risk is 11,000. So even if the market does not go bullish, it starts dropping, I know I have already secured 20,000 rupees. So, and I'm getting the part premium out of this. So that's the advantage of a bull call strategy. And some of you can possibly think that it is a case of the risk profile. If I think about it, let's say a person is, he's a risk taker. Possibly that profile would possibly go for a long call strategy where he says, oh, I don't really care about my 31,850 rupees. I'm willing to invest that. I'm willing to make money. There could be let's say a medium risk profile where you will say, okay, money really matters. I don't have that kind of bandwidth. I would possibly go for a bull call strategy where at least I have my risk is reduced from 31 to 11,000 rupees. And whenever the market goes down, I still have the option of liquidating my position. I can assume that the market is totally going against me, and therefore I have started liquidating. Possibly I can still recover $5,000 from the market. So that's one option. The bull call is a very interesting strategy. It has been a strategy which has also been used for adjustments in certain complicated strategies like iron condor and butterfly strategies, which is totally outside the scope of the webinar. But how do I select the long call strike and the short call strike? I mean, what is the lower strike? The long call we chose as 190 and the short call we chose at 200. Now this again depends on the risk profile of people, of the investor. But there are certain guidelines which experts have suggested over a period of time. The first one is you will select the lower strike price to be near the money, and that's what we are doing. The State Bank of India was at 189.25, which is at the money, as they say, and 190 is the strike price which I have selected. And that makes a lot of sense, right? Because I'm saying from 190, I'm expecting a jump of more than 10% to SBI price. So I have selected the lower strike price, which is close to the underlying asset price. And that's what I've done in this example. The short side of bull call spread, which is this short call strike that I can select. Can I select 195, 200, 210? What should I select in this case? So the answer or the guideline to it is that it should be high enough to create a decent upside. It cannot be that you buy a call at 190 and sell the strike at 191, right? Because that even will not take care of your premium because your break-even point is 200. So we need to see there that the spread offers at least a decent percent of maximum return on maximum risk. I personally prefer, and this varies again from people to people. This is a personal preference, and This means that on maximum risk, and this will take it, this example will be more, these guidelines will be more clearer once we go through some figures. I would expect at least the maximum return, which should be double on my maximum risk. So if I'm risking 5 rupees, I would expect at least a return on of 10 rupees if the stock moves upward towards upper strike price. And selling higher strike call, how does it help? It lowers our cost. Because earlier I spent 30,000 rupees on the bull call spread. It cost me quite a bit. And here I'm also selling the higher strike call while settling for limited profit. It also lowered my break-even point, and that we'll show it as an example. But obviously it caps my upside, which means I don't have the unlimited risk, unlimited profit or long call. But that's not too hard to digest for a medium risk profile like me, because anyway, I'm trying to take care of that with a good risk reward spread. And delta also, the rate of change which we discussed, is also hedged to a great extent, because the fluctuation, if the price goes down, is not much. If imagine that you had a bullish view and the market, you are dreaming about your 31,000 rupees and more all the time because you're paid 31,000. What if the market goes exactly opposite your direction that you're in? Your position gets decimated very quickly. Even before you realize, your 31,000 suddenly becomes, you're just frozen on the screen. The market goes down to 25, 20, 15. Your position gets decimated very quickly with a long call. Whereas with bull call, it does not, because even your sell spread tries gaining with that. So the effect is much slower. It gives us an opportunity to exit this trade. If you say that, okay, my position has been totally wrong, I have time to exit this trade. It gives us some opportunity to exit this trade. You can also exit this trade in the long call strike, but the decline is so fast that sometimes it creates a panicky situation, and you may not be able to justify unless you're an advanced or a serious trader. So before serious damage is done, I mentioned here we can exit the trade, and that's the advantage of the bull call spread. Another guideline is what is the correct time to do the bull call spread. Typically, it has been literature and practice has proved that the bull call spread is much better, not in a short-term trade, but as a long-term strategy. Because as an option buyer, what am I doing? I'm having a bullish view. I'm assuming my view is positive. I'm saying that stock will go up. And I need time. It doesn't happen every day that the stock moves up or moves down, doesn't go to the level at which I'm expecting. And the stock market is one of the most unpredictable areas. And therefore, I need some time. I want as much time to be right. And that's the reason why people say that the bull call spread is a much better as a long-term spread. And here's where what I've done is I have laid down the choices of bull call spread, and talking about the guidelines. I mean, we'll reflect back upon the guidelines where we are saying as to what makes it decide how am I going to choose my short call strike, given the fact that my step one, the long call strike, I'm buying at the cost of underlying. So to repeat, at the risk of repeating, again, the same example, so that you're aware of the numbers, at least familiar with the numbers. The SBI in stock is trading at 190 rupees, 189.25 to be precise. I buy the 190 strike call at 10.65. And then let's say I have three choices. The first one is I can sell a 200 call at 695. And what I've done is I've broken this column down into risk, reward, and a break-even point. And You may want to look at this slide later. I have and the maximum ROI, return on investment. The risk is defined as the net debit of the spread, which means what I've paid for the spread. What I have paid, for example, here we have 3.70, right? So how did I arrive at 3.70? What I've done is I paid 10.65 for the call, but I sold the call also and I got 6.95. So my risk is lessened to 3.70 rupees. So that's my risk. It could have been 10.65 had it been a long call strategy. What's my reward? My reward is 6 rupees 30 paise. The reward is difference in the strike prices less the net debit. How did I arrive at the difference? Which means assuming the call expires, the stock expires at 200, 200 minus 190 is my gain less what I paid, that is 370. So my reward is 6.30. That's my break-even point, 193, which means I need to reach to that point in order to, if I go upwards, I'll make profit. And my ROI is 170%. How have I arrived at 170? The reward upon risk, so 630 divided by the risk 3.70, that's the percentage. So this is what I have listed down. So the second alternative could be I sell a 210 call at 4.45. Again, these prices are realistic figures based on the Friday's closing prices. My maximum ROI is 222%. There is a third option I have is 220 call, which the prices were 3 rupees. So my risk is 7.65. My reward rises to 22.35. My break even is 197. Much higher than the 193. And the ROI increases to 292%. So if you really analyze the bull call spread, and this is very interesting, and there is no right or wrong answer, it depends on your risk profile. Which alternative is better? Now, according to me, who is a medium, not too much risk savvy or risk averse, to me, alternative 2 looks attractive because my break-even point is lowered vis-a-vis the higher if I sell a higher strike call. Secondly, in order to achieve 210 stock expiring, anyway, my view was that the stock will rise from 10% above a little bit. So 14% seems to be okay in the stock price, right? So I'm comfortable with that. And somehow I feel that alternative 1, I'm only getting a 170% ROI, which is hardly an increase of 7%. Anyway, I thought SBI is doing very well. I thought 14 tend to more than 10%, 14% seems to be the correct range. For that, I'm getting 222% risk on investment, 170, which is 50% more than 170%. And possibly I feel that the 220 call is unjustified. 21% of stock increase. I have never seen SBI increasing that over a period of last 4 or 5 years. That's my view. And it's a government backed bank. NPAs are large, but whatever the case may be. But my view is not that. My view is that it will typically rise to 10 to 12%. If it rises to 14%, well and good. So on this basis, according to me, I have decided on number 1, maximum ROI. I'm deciding my break-even point, and I'm deciding that relatively this looks sensible in terms of increase in price, and that's the reason why I have selected this, and it gives me a significant leverage. So that's the advantage of bull call spread. And there is another, I know we are running a little bit short on time, but There is a third bullish view, and which is known as a bull call ladder spread, and this is also used as an adjustment strategy. And this, I would say, is a third strategy. The long call strategy we said is for a totally risk aggressive investor where he's willing to let go of the premium. The second one was bull call where I'm getting certain premium. And this is for a very risk averse trader, very safe trader, who says this, yes, my view is bullish, but 31,000 is a lot of money. It is better that I possibly get all the money back. So what do? Step one would be to sell the 190 call at 10.65, which gives 31,000, approximately 31,850 to 50 bucks. And the second step is the same as bull call strat, ladders, bull call spread, which is selling the 200 SBIN call at 6.95, which means I've received 28,850. My loss is now only 11,000, but this is a ladder. This goes one step further, which says I will sell the next level also strike price at 210, where I get 4.45 and I receive 13,350. Now this actually comes in a credit, but typically what happens is this is used in a scenario where I say my view is, yes, it is at 190. I expect SBIN to rise. I'm very certain that it will rise till 200. Possibly it could reach till 209, 210. So that's my view on this. And if you execute, you could also possibly do this in combination. You can execute a bull call spread, and when the market goes down, suddenly you feel that you're losing that 11,000 bucks because that was the risk. You can sell a third call. Who stops you from selling a call? Because anyway, the market is going down. I get 13,350. So essentially, I have taken care of my risk. And in case the market goes up, so market goes down, worst case scenario, I already taken back my premium. Whatever premium I paid, actually I might result in a positive figure by 1,000 bucks. Maximum price profit here in case the market goes up will be at 200. But the note of caution is beyond the strike 210, the position will reverse. Why? Because you have sold the call. So typically a trader, whenever the price reaches 210 or a little bit higher, they will liquidate the position. So they lock up the profit as well as they have not paid any cost for this particular spread. So that's the advantage of bull call ladder spread. So to summarize what we did in this webinar is we discussed some of the basic option terminology based on the survey which I did for webinar. Number two, we used select option strategies for the Indian derivatives market. Very important Indian derivatives market because as I said in the first slide, the Indian derivatives market is the largest today globally across the world in terms of number of contracts traded. We spoke about the cash secured put strategy, leveraging the definition of selling, which is an obligation to deliver a call or a spread or a stock, take delivery of the stock or giving the delivery of the stock. And then we had a brief view of the bullish strategy, the first being the long call strategy, the bull call strategy where the risk is lesser, and the bull call ladder spread where the risk is, there is no risk when the market goes down. And now I'll open this to certain questions and I'll take based on the common questions which are there. I'm waiting for any questions you have. There's, if there is a time limit, I'm sure you can write an email to the MDP cell, and I'll be happy to take the questions later also, but there is some time, 5 minutes or so, and I'll be happy to take any questions. Yes, I don't see any questions. I'll be happy to take any questions later on also when you have any over the email, definitely. And I see a lot of people outside the state. Thank you very much for the participation. It was great to have you on this webinar. Thank you so much for attending the webinar. Thank you. Have a good day.